In the broad debate about the markets as to whether things repeat or rhyme, September is a really interesting month in which to follow up some historical events which seem to have an effect on the current trading environment. And it certainly gives us some sort of talking point as to where the markets may go. Heightened geopolitics, we've got heightened tensions around debt. Of course, we've got fiscal and monetary tightening at the moment as we see governments and central banks react to this rise in inflation that we've got, which is unprecedented in recent times. Joining us now is the author of the Market Timing Report, Andrew Pancholi, a cycles analyst. Andy, it's good to be able to catch up with you again. We've spoken to you several times in the past about these cycles. We talk about what's happening now, and we talk about the long-term cycles. And I want to get into the long-term picture in just a few moments' time, but and also I want to get onto your market timing report in some more detail later on. But I want to go first of all with what September is in terms of the importance for a cycles analyst. What's going on? Why is September so volatile?
Well, the truth of the matter is that September statistically sees more crisis events than any other month of the year, looking back through history. And also the second to third week, again, on a statistical basis, see more changes in trend across a whole series of markets, Jeremy. So this is a very critical time across the whole cross-section. And of course, we can see the undertones across a whole series of situations geopolitically.
So this idea about rhyming and repeating, we have actually spoken about this in a previous interview, which anybody can follow up on a search under your name and Market Timing Report on YouTube. But just remind us what your view is on this repeating or rhyming, because there is a subtle difference between the two words.
Yes. So, what we see is that there are set patterns and the markets can literally repeat. History can repeat. And, we can look at this in a bit more detail. But quite often you'll get the flavors. So for example, with markets, we'll see a time cycle repeat. I mean, the simple way of looking at this is the decennial pattern. Most of you will be familiar that, years for the stock market, for the equity indices, years ending in 5 tend to see a big move up and a pullback in years ending in 7. And then the last 2 years of any decade tend to see sort of a further move up, and then we tend to see a pullback in years, in the first 2 years of a decade. So that's the first sort of simplistic way of looking at it. It's a 10-year cycle, but there are several other cycles we can look at, and one of the better patterns is is a 30-year pattern and a 60-year pattern where we see history and markets sort of show similar patterns. And now, in terms of repeating, in the ideal case, you will see perfect repetition. I mean, things like the global financial crisis we predicted in 2007 was basically 100 years on from the 1907 rich man's panic, and then the 1807 Embargo Act panic and the 1707 crisis. So that follows a strict mathematical pattern. And the 100-year cycle is very prevalent, as to is the half cycle. We can talk about, grains, for example, 50 years ago, they made a major low. And with the Russian famine 50 years ago, the breakdown of the Bretton Woods Agreement, commodities absolutely skyrocketed, and that started coming in 2 years ago. So these are the broader pictures where you see the bigger repetitions. Equally, what we can look for is the expiry of trends. So you can see an inversion where you might have seen a high a few years back, you might see a low.
Okay, well, let's follow up now with some charts, because it's a good time to be able to look at where we are in terms of the market moves. I know the S&P 500 is quite a good benchmark that we follow. What are your observations about the markets and current trading?
Okay, well, just looking at the technical side and where we are right now, looking at the Friday close, basically we hit the 61.8% retracement, the Fibonacci retracement here on the S&P, and we bounced back up. Now, the point we reacted off and then came back down again on Friday, so we've got a weak close, even though it was a strong day earlier on, was part of this Andrew's pitchfork, and we got back up to the green median line. So that's a make or break point. So if we get above that and retest, then we could head back higher, in which case we're looking at 4,062. But if we carry on down, then this lower red line would be a target. So putting the pitchfork together with the Fibonacci levels gives us a bit more clarity and direction. And most importantly, it gives us points to manage the risk from in terms of the S&P 500.
Okay, so you've got a nice support there at 61.8%. So I guess if it closes below there, you're then on the way to a total retracement. I want to take a look, if I can, at this in terms of the longer term picture on the S&P 500, because you spoke at the top about some of these large long-term cycles. And I know you've got charts which show us how there's a certain sort of symmetry, I suppose, even if it's an inversion on what happened 30 odd years ago.
Yeah, well, actually, the key one for the S&P really is the 60-year cycle, the 1962 pattern. And we spoke about this earlier. I think we started talking about this last January, I think. And what we can see here is in this chart here, we've got the blue line showing the overlay for 1962, and the black line is basically the path of the market. So whilst not a perfect fit, it's not a bad fit at all. We tend to see alignments of lows and highs. And there's several key points to note. I mean, we spoke a few months ago about a potential low coming in June. Now, people were very, very bearish. But based on the 60-year cycle, we did get that. And also the 90-year cycle, which was the end of the 1929 crash depression in 1932 in terms of the market, saw a low the first week of July. So we put our clients on alert, and that worked out pretty well. But looking ahead, now this is really interesting. There's a few things to note. We're just heading down here. We might pop up then into mid to late September, and there's quite a sharp sell-off showing there, and then possibly more trouble into October. But the year does end with a rally. But if we look at the 1962 historical overlay, what was going on here was all the way through 62, there was a real escalation in the Cold War. And this really culminated with the Cuban Missile Crisis, which is when the Soviet Union positioned missiles over to Cuba within easy striking distance of America. So there's this really high level of tension. And of course, we've seen Putin in Ukraine. We're seeing an escalation of tension between China, Taiwan, with US intervention, offering to put money in there, etc. So you can see that this Cold War really is it's heating up. And that was the 1962 pattern there that overlaid. In terms of crises, though, the 30-year pattern takes us back to the ERM crisis, where the pound absolutely plunged mid-September.
Well, let's pick up on that point about sterling, because it's a good point to talk about this. As of the time that we are speaking, we're awaiting some breaking news coming through from Downing Street to confirm, as many expect, that Liz Truss will take the mantle of new Prime Minister. Certain amount of political stability will be welcomed, I guess, by the markets. But what about sterling? What are your thoughts on sterling in the context of you as a cycle analyst looking back at such things like the ERM? I mean, it's a lot of potential pressure for sterling at the moment.
Yes, so we've seen this absolute collapse in sterling over the last few weeks, and we're just approaching this old low here of 2020 down at about 114.10. So that in itself would, on a technical chart reading basis, would suggest we are approaching a degree of support. We can take that further, and this pitchfork, together with its internal lines, give us reason to suggest we might be at a degree of support where we are now at 115. I see we're pretty much flat this morning, awaiting the announcement of the new Prime Minister. But these lines here have proved to be very valid. The intermediate lines have created a lot of good support and resistance points. So, that's the situation there on the pound. Now, the other clue, and this is what really gives us the edge, is that we look at recurrent time cycles here at the market timing report. And if we see a cycle appear, then that gives us more confidence in looking for a reversal. It's actually a set of cycles coming together that suggests the energy is about to pivot. If you have a look at this, is actually a monthly chart off cable, really going back to 2006. And what you see underneath this are our histogram spikes. They're not volume spikes. And where they spike, we tend to see some significant changes in trend. And most importantly, they are predictive, and that we know them before the event. So we have got a reasonable spike here, suggesting that we are going to see some degree of reaction where we are right now. And there's actually quite a significant spike coming up at the back end of 2023, where I suspect we'll have a significant change in the direction of sterling. But this is the macro picture, and we fine-tune these down to the day using a set of smaller cycles and fractal patterns. So that's what we do at the Market Timing Report. And the key point really is that because we have these cycles, we can look for more confidence. We're reaching a double bottom. You don't know if a double bottom is going to hold or collapse. And if you have a cycle, the chances of it holding and reversing are much stronger. So mathematically, the probabilities are in your favor. So the other thing is, we talked, Jeremy, about the George Soros £1 billion pound deal in a day where he broke the Bank of England. That was on the 15th, 16th of September. And that was because, due to inflation, etc., and other consequences, other events around the time, Britain was having to pump more, the Bank of England was having to buy more and more sterling just to keep it within the exchange rate mechanism, within its band of 6%. And you could see that just wasn't going to happen. So we saw this significant high on the 9th of September. And, you can see how it had been heading up. And then it absolutely collapsed from $2 down all the way down to 140. So we're in the opposite pattern. That would suggest that the 30-year cycle is possibly showing an inversion. So we need to be on alert for an inversion on the British pound. So this is this idea of history rhyming rather than repeating. But the most important thing about the ERM crisis was that it impacted every market. It wasn't just the British pound. It wasn't just the FTSE, the American markets, the dollar index, commodities. Everything was impacted by this event 30 years ago. So I'm not saying we're going to see anything of a similar magnitude, but we do need to be on alert, and we can expect a lot of volatility. And of course, the key interventions on the 15th of September 1992 revolved around sudden massive interest rate hikes. I mean, they came down again within a couple of days, but what we saw there was unexpected massive intervention. So I'm just wondering if the forthcoming interest rate changes might be higher than expected, and maybe there's a little bit of a curved ball lying ahead with any government intervention on either side of the pond.
But of course, that could also come, of course, in the context of there's a real concern about whether or not we are getting to the point of massive recession. And I wonder whether perhaps maybe there might even be some outliers suggesting that one of the shocks we could end up seeing is possibly a retracement of some of the interest rate rises that we've had. Can I just quickly return, before I take a look into more detail at your market timing report, because I'm interested to see more about what it is you're trying to achieve here. But can I just quickly go back to sterling, because this double bottom pattern here that you're talking about, this idea that we've got this potential inversion where you say that if it gets this support, we could well then see sterling rally. Of course, the other side to that is if we do get a break, candle close, or a significant break of that line, and you get the markets continuing down, presumably, then we are possibly then on to further downside. I mean, it's very difficult, isn't it, when talking about the timing, to work out just where the markets are going to move. You're highlighting this line of support, but it could also turn into a line of new resistance.
That's absolutely right. So I was just looking back at the older charts there. I don't have it with me, but if you look, the next level is all the way down at $1.05. So pretty much approaching parity. And yes, nothing is impossible in this world, but $1.05 is a possibility if things do not stabilize. It really is a potential target. I would say if it gets there, that would be a very strong support level.
Yeah. Just very quickly going back to London and the FTSE 100. How's all this dovetail with what's happening with sterling?
Well, this is the FTSE as of the weekend. What we saw was this pitchfork here has held the lows quite nicely. We got a nice reaction up there. We're down a little bit there, but we're still containing this lower line here. So the first point to make really is that although we are seeing lower highs, we have also seen lower highs. We're also seeing a series of higher lows, and we're just holding there. But if that does fail, then we are really looking at this geometry here. Now, there's a few lines on here, so let me walk you through it. First of all, this is the same pitchfork you saw on the previous page. And if we project these lines backwards, we see some tremendous support and resistance all the way back off all three of the red and green lines. So that's the first point. This is quite an important pitchfork. But But if it goes down, then if we take the parallel lines from it, the geometry from these from the October 2020 low, that comes down to here, and that also coincides with the 0.236 retracement of the whole move up from the 2020 low all the way up to the high. So that these all then really get together round about 7,033. And there's the downsloping pitchfork added there as well. And what we see is that median line coincides with the 236 level at 7,033, which also coincides with a parallel geometry line. So that really is the first point to look at. And then a breakdown of that level, if things start unraveling even further, suggests 66.28 would be a significant target.
Okay, that's quite a lot lower. Just wanted to take a look at why September, going back to some of these events that we're talking about, because historically there are a number of things that have happened in September, which gives us alarm bells. And I know you do cover this in your market timing report as a matter of social historical interest. Which actually gives us this idea that September is such a volatile month and can produce all these curveballs in your word. Just list some of the events that I know that you look at as someone that's looked at these markets in historical events.
Yeah, sure. So what we do is we look for patterns, and nothing is certain. All this work does is gives us clues about when the market might change trend, and these add to incremental gains in portfolio management. And it's worked very well for us. I mean, so far this year, we're up 33% year to date. And if we go back, the first point to look at really, well, actually go back last year, we got the massive change in overnight rates and the repo rate. But we can go back to 2008, as I mentioned before, 15th of September 2008, the Lehman Brothers. Go back to September the 11th, 2001, 9/11, the markets were closed. Go back to 1998, and I think this is a fascinating one because, again, a bit of history repeating here. September, the first 2 weeks of September saw the sort of downfall of LTCM, long-term capital management. Well, this was the hedge fund run by John Merriweather together with Myron Scholes, the guy behind the Black Scholes model. These guys were the smartest guys in the history of finance. But from the end of August 98 to the second week of September, their AUM went down from 2.3 billion to 400 million, a six-fold collapse in their AUM in 2 weeks. And why was that? Well, they'd got the bonds, the bond crises were affecting them. They had a heavy exposure to them. But it was the Russian crisis, Russian financial crisis back in 98 that impacted them there. But we can take these cycles further back. And, we've just talked about the 30-year ERM crisis. We can go all the way back to 1962, the Cuban Missile Crisis. We've been looking at that overlay there. Then we can go back to the Suez Crisis in 56, 1939, so some geopolitical events, but they've all impacted markets. The outbreak of the Second World War, 1873, the Jay Cooke collapse. That was the end of the end of a big railroad run. The bonds all collapsed, but that crisis actually started in Europe, in Austria. And you go all the way back to the 1720, the South Sea bubble collapsed in September 1720 as well. So that's just a quick overview. I mean, there is a lot more to it than that. But within these patterns, we look, within these events, we look for cycle patterns, and some of them align. Basically, when we see multiple harmonics coming together, you know that something's going to impact quite severely. But that's a quick overview, Jeremy. Yeah.
Yeah, no. It's fascinating to run down that list, but I think in terms of where we are now, I always like to think of the fact that maybe perhaps with the increased amount of communications we've all got, one, there's more transparency available from central banks. So I think we get a better idea as to what they're going to do, and they do like to signal, don't they? We know more about what's going on because of social media, and I think technology as well helps us through. Let's hope that some of those new developments will help us avert another crisis, because clearly no one wants that. And I don't know how much people are prepared for the potential downside if things do fall apart. But do you get the feeling that perhaps maybe we are in a new era, or do you think that the market's just going to follow on whatever?
Well, we're in a different era, but human behavior definitely repeats. And there's a certain book that says that there is no new thing under the sun. And we see, we're in this Cold War cycle, which is potentially escalating into, well, we have got physical conflict going on. These war cycles repeat in absolute patterns. There's a cycle that takes you back to 1939, that takes you back to the Crimean War, that takes you back to the American War of Independence. They are perfect mathematical proportions. So, human behavior doesn't learn. And it's because everything's in generations and multiple generations, and people forget or haven't lived through the crises. So our work over the last, well, dare I say it, 30 years has proven categorically that history does unfortunately repeat. And whenever you hear that phrase, this time it's different, you just want to manage your risk a little bit more carefully.
That's exactly what it's about, Andy. It's managing risk. Look, thanks indeed for your time. It's great to be able to catch up with you and for you to give us a little bit of a lecture on just how much perhaps maybe history should be followed in terms of where we are, what we're doing, how we go about trying to approach things differently. Let's catch up in the studio next time. It'd be great to be able to speak again, perhaps maybe later on in the year, and see how things develop. But Andy, in the meantime, thanks for your time.
Thank you, Jeremy.
That's Andrew Pancholi. He's the author of the Market Timing Report.